Imagine this. Every stock you own just doubled. Your net worth absolutely explodes. Now, imagine on the same day, your landlord raises rent 40%, your grocery bill is insane, and the headline on every news channel is that the dollar is tanking. Are you richer or are you trapped in a dying currency that's tricking you with bigger numbers? Because when other countries' money collapsed, their stock markets went crazy too, and almost nobody came out ahead. So here's the real question. If the dollar really collapsed, would the stock market actually save you? Or would it be the thing that finishes you off? That's what this video is all about. You've probably seen the thumbnails. End of the dollar, death of the American empire, how to get rich when the dollar collapses. There's this whole ecosystem of fear and hot takes and very confident people telling you the dollar is about to end. Perhaps they're trying to get views, or sell you a newsletter or a course, or maybe they're trying to get you to buy their precious metal, which, by the way, they're super eager to trade you for your hard-earned dollars that supposedly are about to become worthless. I personally even use many of these scary titles and thumbnails to get people to watch these videos that are designed to debunk many of these conspiracy theories that are literally all over the internet. And in the comments of my videos, the same question keeps showing up in different words. What happens to the stock market if the dollar collapses? Should I just buy stocks when the dollar dies? Is the S&P 500 the ultimate hedge? At first I treated it like a thought experiment. Then I started reading about places where their currency really did collapse. There was Germany in the 1920s, Venezuela in the 2010s, Argentina for like the last several decades, and parts of Asia during the 1997 and 1998 crisis. The weird thing is, the stock markets in those countries did not behave the way modern-day expert YouTubers would expect. Sometimes they went to the moon, sometimes they crashed, sometimes they did both. And the more I researched and the more I read, the more it seems like this isn't just a question about stocks. It was a question about money itself. So let's start by talking about what everyone thinks is happening. There's a very common story about how this all works. It goes like this. The US prints too much money. Other countries get spooked. They stop trusting the dollar. They start doing trade in other currencies. And eventually they dump their dollar reserves. And subsequently, the dollar collapses. In this chaos, you're supposed to buy the right thing. The right stocks or gold or Bitcoin or whatever the video happens to be selling. Everyone who doesn't follow the advice gets wiped out. You get rich because you saw what nobody ever sees coming, but nobody ever really sees it coming. So this whole story, it's very clean, very simple to understand. There's a clear villain, it's money printing. There's a clear hero, the asset that they want you to buy. There's a simple moral, buy now and thank me later. But when you look at real currency collapses, that story gets messy very fast. You see, stock markets can multiply 10 or 100 times in their local currency, yet the people holding those stocks are still getting poorer in real life. You see countries where the currency and the stock market both crash at the same time. You see foreign investors getting absolutely wrecked even when locals look like they're winning. So in this video, I want to treat this like an investigation. We're going to start by going back to the places where money actually failed. Then we're going to watch what happened to their stock markets, step by step. Then we're going to extract the mechanisms and come back to the dollar and ask, okay, what would this look like here? So let's rewind back to Weimar Germany. Let's start with the classic example of currency failure. After World War I, Germany owes huge reparations. The government is broke. Instead of raising taxes enough to pay for everything, it leans heavily on borrowing and printing money. Inflation starts to creep up around 1921 and then turns into full-blown hyperinflation in 1923. The exchange rate between the German mark and the US dollar goes from hundreds of marks per dollar to thousands to millions and eventually into the trillions before the currency is replaced. So what happens to the German stock market at this time? In terms of marks, stocks absolutely explode higher. Charts from the time show the main stock index rising by insane amounts as people dump cash into anything tied to real assets. On paper, it looks like one of the greatest bull markets in history. But here's the catch. If you measure those same stocks in a stable currency, or you adjust for inflation, you get a completely different picture. One detailed reconstruction of the German stock index shows that relative to its pre-war level, the real value of German stocks falls by an order of 90% plus. roughly a 97% loss in real terms at the lowest point, despite the huge nominal gains that, from the inside looking in, seemed like they were massive. So in Weimar Germany, the stock market is a mirage. The numbers go up, but your real purchasing power goes down. Now, let's fast forward about 100 years to Venezuela. A combination of oil dependence, mismanagement, sanctions, and political crises lead to one of the worst hyperinflations in modern history. Prices at certain points are rising at hundreds of thousands of percent per year. Now, look at the Caracas Stock Exchange. Its main index, often called the IBC or General Index, has periods where it becomes the best performing stock index in the world by returns, at least in nominal terms. At one point in the mid 2010s, it was up almost 600% in 12 months. A perfect hockey stick chart, which is absolutely crazy. But if you adjust for inflation or you convert those returns into dollars, the miracle mostly disappears. The stock market chart, when shown in a collapsing currency, gives a false positive. For many Venezuelans, buying stocks was less about investing in companies and more about trying to get out of the dying currency. The stock market becomes a slightly less awful lifeboat on a sinking ship, not a road to real wealth. Then there's Argentina. This isn't a single collapse. It's a recurring pattern of bouts of high inflation, runs on the currency, IMF programs, devaluations, capital controls, and political shocks. Over the years, the Argentine peso steadily loses value against the dollar. In 2025, the country's main stock index actually becomes the worst performing stock market in the world among major benchmarks, dropping around 30% in local currency in just the first 8 months of the year. So in this case, unlike Venezuela, you don't always see a stock market that saves you in local terms. Sometimes investors try to flee into equities after big devaluations, pushing prices up for a while. Other times, the currency and the stock market both suffer at the same time. For foreign investors, it's often even worse. You lose on the stock price and you lose on the exchange rate. Now jump to Asia in 1997 and 1998. Countries like Thailand, Indonesia, and South Korea have been growing fast, with lots of foreign capital flowing in. Many borrowers, companies and banks, took on debt in the US dollar because it seemed cheaper, not to mention more stable. Then the Thai baht comes under pressure in July 1997. The government abandons its peg to the dollar. The baht plunges. Panic spreads to other currencies. Stock markets and currencies in the region fall together. And foreign debt burdens, measured in local currency, explode. Foreign debt to GDP ratios in several Asian economies go from about 100% to well over 160% in the mid-1990s, and then even higher during the crisis. In this case, there's no giant stock boom. You get currency collapse and stock collapse at exactly the same time, especially where firms have big dollar debts. So what do these stories have in common? Well, let's simplify it. In a country, you've got three main actors: households who earn wages and hold cash or savings, companies who earn revenues, own assets, and have debts, and the government, which taxes, spends, and sometimes prints money. Now, imagine the local currency starts to slide. The first step is people not wanting cash. If your paycheck is in a currency that's losing value fast, you don't sit on it. You spend it as soon as you can. You buy food, dollars, gold, any durable good, and sometimes shares in companies that own real stuff. That wave of get me out of cash can push the stock prices up in a local currency. That's the Weimar and the Venezuelan pattern. The second step is companies with real assets look safer. Firms that own factories, land, oil wells, inventory, anything tangible can look like a better place to park value than a bank account in a dying currency. So money floods into those stocks. In step 3, foreign currency debt can kill you. If those same firms have borrowed heavily in a stronger foreign currency like the dollar, while most of their income is in the collapsing local currency, then every step down in the exchange rate makes their debt burden bigger in local terms. That's what happened in parts of Asia in the late 1990s. Currency crashes blew giant holes in corporate and bank balance sheets. Investors didn't run into stocks, they ran away from them. In the fourth step, inflation creates the illusion of big numbers. When prices in your economy are doubling, tripling, or even worse, corporate revenues and earnings in nominal terms can look amazing. The same physical product sells for more units of the local currency. But if that currency buys much less than before, those flashy earnings don't mean what they used to. That's why Weimar and Venezuelan stock charts look incredible in local money, and much less impressive in real or foreign currency terms. So whenever you hear, in this crisis, stocks went up X thousand percent, you always have to ask, in what currency and compared to what? But there's a twist to this whole thing. Once you line up these case studies, the original question starts to change. What happens to the stock market when the dollar collapses? Sounds like a question about stocks. But after looking at Weimar, Venezuela, Argentina, and the Asian crisis, it starts to sound more like a question about the measuring stick. In Weimar, Germany, the problem wasn't that people picked the wrong stocks. The problem was that the unit, the mark, was disintegrating underneath them. In Venezuela, the best stock market in the world was priced in a currency that was effectively on fire. In Asia, the problem wasn't just volatility, it was that companies had debts in one currency and income in another, and the exchange rate moved violently between them. So the deeper question isn't, can the stock market save you when money breaks? It's what happens to all the numbers you care about, salaries, stock prices, and savings, when the unit you measure them in stops being trustworthy. And that's where the dollar comes in. Right now, the dollar is still the main measuring stick for the global economy. According to the Federal Reserve and the IMF, about 58% of the world's disclosed foreign exchange reserves are held in dollars. The euro is a distant second at around 20%, with the yen, pound, and renminbi each in the single digits. The dollar's shares declined from a peak of about 72% in 2001, but it's still far ahead of any competitor. Recent surveys show central banks slowly diversifying, holding a bit more gold, a bit more non-dollar currencies. But they also emphasize that the dollar's dominance persists because the US financial markets are deep and liquid, especially the treasury market. So what would our three patterns look like if they showed up in the dollar? I find it helpful to think of them in terms of three stories: a weak dollar, a broken dollar, and a dead dollar. In the weak dollar story, nothing explodes. The dollar just leaks power. That's kind of what's been happening. Over a decade or two, it loses, say, 30 to 50% of its value against a basket of other major currencies. Not through a single crash, but through a lot of small decisions. More trade invoiced in other currencies, a gradual shift in reserves, slightly higher inflation in the US than people are used to. Maybe instead of running at 2%, it runs at 3 to 5% for a few years. That's annoying, but not catastrophic. A broad US index like the S&P 500 might still go up in nominal terms, especially because many of its biggest companies earn a large share of their profits overseas. When those foreign earnings are converted to weaker dollars, they look larger. Historically, US multinationals have often done better when the dollar is weak because of this translation effect. But when you adjust for that persistent inflation, and maybe for a weaker international purchasing power, your real returns are less impressive. Your lifestyle feels more sideways. Exporters and globally diversified firms look relatively good. Import-dependent companies and purely domestic players get squeezed by higher input costs. Now, let's look at the second scenario. In the broken dollar story, trust doesn't just erode, it cracks. Maybe there's a messy sequence of debt ceiling crises and political standoffs that make investors question whether the US can reliably govern its finances. Maybe geopolitical shocks make foreign governments more cautious about holding dollar assets. Central banks start trimming their dollar holdings faster, shifting into other currencies and gold. Yields on US treasuries rise as buyers demand a higher return for the risk. The dollar drops more sharply on foreign exchange markets. Inflation stays stubbornly high. In this world, the math behind stock valuations change. When interest rates go up and inflation is less anchored, the present value of future earnings falls, and investors want a higher risk premium. That usually means lower price to earnings ratios, even if nominal earnings look big. So you can have a decade where corporate revenues rise in dollars because everything costs more, but stock valuations compress, and inflation eats into whatever returns shareholders see. For US investors, this feels like a choppy, frustrating market where the index may move sideways in real terms. For foreign investors, it can be worse. If you're in Europe or Asia, the dollar is falling faster than US stocks are rising. Your holdings are shrinking in your home currency even when the S&P 500 looks okay in dollars. So in the broken dollar scenario, US stocks are no longer the uncontested, safe global asset. They're just one risky bucket in a more multipolar system. Then there's the nightmare story, the dead dollar. To be clear, most economists consider something like a Venezuelan-style or Weimar-style hyperinflation in the US extremely unlikely in the near term. The dollar's entrenched global role, the institutional power of the Federal Reserve, and the size and depth of US markets all make a full collapse hard to imagine. But unlikely isn't the same as impossible, and it's the scenario people are picturing when they talk about the dollar collapsing. In this storyline, trust in the dollar breaks completely. The government ends up monetizing large deficits. Inflation goes triple digit. Prices change week to week. People rush to convert each paycheck into anything else. In that situation, the US stock market would probably do what Weimar and Venezuelan markets did, go vertical in nominal terms. The Dow wouldn't be at 40 or 50,000. It could be in the hundreds of thousands or millions, and the headlines would scream all-time highs. But those points would be measured in a unit that's melting. In inflation-adjusted terms, or in terms of another relatively stable currency or gold, equities could be flat or down, just like in Germany and Venezuela. Everything changes when you put it in terms of a common denominator. And if the situation got bad enough, markets themselves might not function normally. There could be trading halts and shortened hours, capital controls that limit moving money in or out of the country, forced conversions into a new currency, or new rules for pricing assets. That's not an investment environment anymore. That's a political crisis. Across all three scenarios, weak, broken, and dead, one thing is constant. The stock market is not some magical escape hatch from a currency crisis. It's another mirror reflecting that crisis back at you. Now, let's zoom out and talk about what this means for the world right now. A huge share of global savings is parked in US assets. Central banks hold dollars and treasuries as reserves. Pension funds all over the world own slices of the S&P 500. Corporations borrow and lend in dollars because the market is so deep and liquid. They're not just betting on individual US companies, they're betting on the dollar and the legal and political system behind it. If the world moves from a strong dollar regime to a weak or broken dollar regime, the global map of safe and risky changes. In a gentle weak dollar world, it might just mean more trade invoiced in euros or won, more reserves held in gold or other currencies, or a bit more money flowing into non-US stock markets. In a broken dollar world, the shifts are harsher. Sudden capital outflows from US assets, higher borrowing costs for the US government, tougher choices on taxes and spending. In the extreme dead dollar world, you're not tweaking portfolios. You're rewriting which countries get to borrow cheaply, who can weaponize their currency through sanctions, and whose crises destabilize the whole system. So this isn't just about your brokerage account, it's about power. Now, let's talk about regular people. You're probably not a central bank governor. You're not managing a $1 trillion reserve portfolio. You're more likely someone who has some savings, maybe some investments, and a lot of questions. If this scary thing happens, am I okay? Is there something I'm supposed to do now? Well, first of all, nobody can predict what's going to happen. And second of all, even those who can predict it, it's probably a coin flip of whether or not they'd be able to give you the right advice. Because in these sorts of scenarios, it's the unexpected things that make the biggest difference. And if they're unexpected, you probably can't plan for them. So it is important to note that currency risk is real, even in rich countries. If all of your life, job, house, savings is denominated in a single currency, then that currency's fate is your fate. And for most Americans, we've never really had to think about this. And the question is whether we even do have to think about it. But bottom line is you don't have to panic or move everything into another currency. But it is worth acknowledging that this is a real risk, not a YouTube invention. It's just probably overblown on YouTube. And there's also portfolio risk and there's system risk. In normal times, you manage portfolio risk by diversifying across assets. The idea is if one thing goes down, another might go up. In a true currency crisis, what moves isn't just one asset, it's the system. The system is the measuring stick, and it's shaking. That's much harder to hedge against. Looking at history, the people who got through those periods and did the best, they didn't just make a clever trade. They had flexible skills, social networks, and community support, along with lower fixed expenses, minimal debt, and sometimes the ability to move or adapt. That doesn't fit neatly into a ticker symbol, but it's actually what showed up in people's lives. When I started working on this whole video, I thought I was making a video about the stock markets. How do they behave in crises? Can they protect you when everything feels unstable? But the more I read, the more I researched, the more it hit me that this is really a story about trust. Trust that the number on your payslip will mean something next month. Trust that if you save for years, it will add up to choices and security. Trust that the unit we use to measure everything in our lives isn't quietly melting underneath us. So when someone asks, what happens to the stock market when the dollar collapses? I think the honest answer is, we really don't know. Oh, and by the way, if you want to know what happens to your debt, or you want to know what happens to real estate when the dollar collapses, make sure you check out one of these videos right here.